These days, the word liquidity is in every second video on trading. Everyone says it is important, but almost no one explains why liquidity is not just a term, but the foundation of trading, which determines where the market will take and where it will make money. Just one understanding of liquidity can change your trading forever. I'm not saying this in theory. In fact, I made $4,199 on one of my trades on the NASDAQ in just one day. And it wasn't random. All of my trading is based on understanding liquidity, where others enter, where they put stops, and where the price will go to take them. In this video, we will analyze this trade in detail so that you can see everything clearly. But first, let's look at the most important things: what liquidity is, how it controls the market, and how to find it on the chart even before it moves. First of all, remember, the market always moves from liquidity to liquidity. This is not just a nice phrase. It's a way of survival for the big players. Now imagine you are trading according to technical analysis. You see a level, you draw support. You see that the price has already bounced 3 times. It means that the level is strong, and at this moment you are no longer analyzing. You believe in the level, in the pattern. You believe that everything will work as before. That's what makes technical analysis a self-fulfilling prophecy, until everyone sees it. And when everyone sees it, it's already a bait. Why? Because thousands of traders enter the same way. They put stops in the same zones, and that creates liquidity that the market maker can use. He's not looking at the level. He's looking at where he can get volume. And volume is you with your stop behind a safe zone. You think the level works because it's strong, but it works because it's behind your bet against a big player. He's just taking it. And that's why liquidity is not magic or smart lines. This is crowd psychology elevated to a strategy. Liquidity exists because most people act the same way. Because the majority of people want a simple thing. If they see a level, they enter. Put a stop and wait. But the market is more complicated than that. Understanding liquidity, it's when you don't run after the movement, but wait for everyone to get knocked down. And only after that, you enter. It's a mindset that changes everything. Now let me show you how all of this applies in practice. This is my actual trade on the NASDAQ, and here I was, not acting as a techie, but as a trader looking for liquidity. I build scenarios on the higher time frames and hold the position for as long as I need to. In this case, a little over a day. At the beginning of the week, I opened the chart, and the first thing I did was mark the key zones, last week's high and low. These were my reference points because it was there, with high probability, that other traders' stops were placed. The market had to pull towards these zones sooner or later. Next, I highlighted the imbalance area. Yes, there was already a reaction from it, but such zones work repeatedly, especially if they coincide with potential liquidity. That's why I left it on the chart as an important element of the scenario. Next, it's a wait-and-see scenario. No guesswork. I had 2 clear options. If the market takes liquidity off the top, I look for selling. If at the bottom, I look for buying. It's a simple but powerful principle. I don't trade direction. I trade reaction to liquidity. After a while, a double bottom forms. For most technicians, this is a reversal signal. Some traders are going long from the level, while others are preparing for a breakout and shorting. But I know this. Once the crowd starts putting stops by the book, it becomes the perfect target. The market breaks the level down, takes out all the stops, and immediately bounces right back up. This is the moment I've been waiting for. A move back inside the range after liquidity is grabbed is the signal to act. I'm going long. Take profit is the upper boundary where the next liquidity is. The trade brought a profit of $4,199. But the main thing is not the amount. The main thing is that it was not a random entry, not an impulsive decision, but a work according to a clear scenario based on the market logic. But to make you really start to see the market the same way, let's go even deeper. Because liquidity is not just where the stops are, as every other video tends to say. That's just the tip of the iceberg. Liquidity is actually about being able to execute a large trade with minimal slippage. When an institutional investor with $100 million in volume wants to get in, he can't just push a button. He needs a counterparty. Who? You. Retail traders who long from the level or short on the breakout. That's why he creates a structure you'll believe in. He shows a pattern, a false breakout, a confirmation, anything to make you give up your liquidity. And only then he moves the market in the direction you want it to go. For this reason, real liquidity is not an area on a chart. It's a consequence of the crowd's behavior, not the line itself. Because the crowd acts the same way. And that behavior translates into predictable entry points for strong players. This is the whole point of the smart money approach. Not to predict the market, but to read the behavior of those who create the movement. It's not about levels, it's about perception and reaction. And the sooner you understand it, the sooner you will start trading with profit. If you want to get a deeper understanding of how market makers operate, watch our video, Who Moves the Price? There you'll see how the big players provoke, gain volume, and move the market using liquidity as fuel. Now that you understand what liquidity really is, let's put it all together. Here's a step-by-step plan on how to build trades based on liquidity, not by guessing, but by following a script. Firstly, we define the key zones and create a scenario of our expectations. We start with a higher time frame, D1 or H4. We mark the high and low of last week. These are potential targets for liquidity GRAB. Look wider. Is there an imbalance near these zones, as there was in my trade? This reinforces the level and gives a point of reference for the future. After that, we move into the role of observer. Our job is not to predict, but to watch what the market does. Even if the price approaches our zone, we don't rush. Liquidity grab should happen. Only after that we look for confirmation, and we are doing it on the lower timeframes, M5 or M15. It can be a return inside the range, a reaction to the FVG, or the formation of a new impulse. An important point, an order block makes sense only when it is formed after liquidity grab. Without it, it's just a piece of chart. When we have a reaction and confirmation, there comes the moment of entry. A conservative option is to enter from the imbalance zone. More aggressive right after the price returns inside the range, and in any case, the stop is placed consciously, either behind the manipulation extremum or, if the distance is small, behind the FVG itself. Do not be greedy. The goal is not an ideal point, but a system trade. Take profit the next liquidity zone. No buy feel. Everything is according to plan. This approach works not because of luck. It works because it's repeatable. You don't chase the market. You watch it play out the same script. Grab, reaction, pullback, entry. That's real systematic trading. But let's be honest. Not everyone has the opportunity to sit by the chart for hours and wait for this scenario. Someone is working. Someone simply lacks experience, patience, or confidence in their actions. It is for these situations that I created MiloBot PRO, a trading robot that takes a systematic approach and turns it into an automated strategy. It doesn't use smart money. It doesn't recognize liquidity manually, but it does what's important. It follows a clear algorithm with confirmation, stop, and risk control. Over the last 4 years, the MiloBot PRO account has grown from $34,000 to $272,000. And you can check it for yourself. The statistics are fully available on my FX book. If you want to test it risk-free, just download the demo version, run it on history, and see how it trades, and then you can make a decision. The link to MiloBot and its demo is in the description below this video. Understanding liquidity is not another trick from a trading course. It's a mindset shift. It's the moment when you stop chasing every move and start seeing why the price went there, where the stops were, where they were taken out, where the mark of a major player appeared. You are no longer acting blindly. You have a structure, a script, and a logic that can be repeated. Yes, not every trade will be perfect. Yes, the market will test your discipline. But if you trade by reacting to liquidity rather than reacting to reactions, you're already one step ahead of most. That's how a professional trades. That's the mindset of those who actually take money out of the market, not give it to the crowd. If this video helped you see liquidity in a new way, please give a like and subscribe. Trade with your head, and remember, price always goes where you are most unwelcome.